Everyone wants to generate income effortlessly. This is the enduring illusion of the modern age. People imagine passive income as sitting on a beach where money grows by itself. What they actually long for is to get something for nothing, a concept that has never existed in any era I've lived in. In my youth, speculative crowds sold gold mines without the gold. Today, they sell online courses, cryptocurrencies, and automated trading plans. The packaging has changed, but the mindset of bullshit remains the same. One simple truth: if it sounds effortless, it's a trap. Wealth can't be hacked or rushed. It's built brick by owning productive assets that generate income even while you sleep. This requires three key elements: capital, patience, and discipline, three qualities most people lack. Benjamin Graham taught that the path to true passive income is rarely glamorous, often boring, but enduring. You don't need complex derivatives, exotic real estate, or AI-powered solutions. What you need is ownership, shares in solid businesses that produce real profits and withstand the tests of real life. Then, and only then, does compound interest do the heavy lifting. Most investors fail because they misunderstand passive. They think it means laziness and non-intervention. Graham emphasizes disciplined restraint, knowing when to act, and, more importantly, when to do nothing. During periods of market turmoil, many panic, chase trends, or try to outsmart everyone. Graham and his contemporaries quietly bought undervalued, intrinsically strong companies and held them for decades. This is how passive income grows, not by constant action, but through patience, regularity, and consistency. The average investor seeks excitement. They pursue the new, shiny, and fast path to wealth. Graham's advice was the opposite: own fewer, higher quality investments and resist intervention. The true measure of compound interest is dividends, not advertising. By the businesses people rely on every day: food, utilities, pharmaceuticals, and ignore the noise of politics, interest rates, and market frenzy. Even when the world is in turmoil, their income will continue. Compound interest is simple arithmetic, not mysticism. Reinvest your earnings, be patient, and resist the urge to tinker. Every time you unnecessarily adjust a growing investment, you create risk and inefficiency. True passive income comes from patience, not activity. It builds quietly, methodically, and often unnoticed over years. Those who understand this principle eventually achieve financial freedom without drama or shortcuts. The tragedy of most investors is impatience. They can't stand still. They constantly check charts, read headlines, and react to every market movement. Graham emphasized that the true work of investing is mental, not mechanical. It requires the discipline to repeatedly say no, the courage to ignore the noise, and the patience to let compound interest accumulate over decades. The market is a test of temperament, not intellect. Every generation believes they've found a shortcut. In the 1920s and 1930s, it was speculative stocks and dubious ventures. In the 2000s, dot-coms and cryptocurrencies promised quick riches. Every cycle ends the same way. Those who pursue innovation lose, while those who stick to fundamentals win. Graham's principle remains unchanged. Invest in quality stocks, hold for the long term, and let time take its course. It's not flashy or popular, but it's effective. Passive income is measured not by the immediate cash generated, but by its sustainability. A dividend is valuable today, but the real measure is how reliably it will be paid decades later. Graham likened it to planting a vegetable garden. You don't cut down trees for short-term gain. You cultivate them and reinvest their yields into more trees. Over time, the vegetable garden becomes self-sufficient, and its vegetables multiply without constant labor. Similarly, Owning well-managed, profitable businesses creates a growing income stream with patience and reinvestment. The allure of high returns often masks risk. Companies promising 10% dividends may be returning capital rather than generating growth. Graham emphasized steady and sustainable growth, consistent, boring dividends that quietly compound. Coca-Cola and See's Candies exemplified this approach. Simple, straightforward businesses with loyal customers and predictable profits. By reinvesting dividends, the investor benefits from both the company's earnings and the reinvestment effect, generating exponential growth over decades. The discipline required is paradoxical. The less you act, the more your wealth will accumulate. Most investors fail because they confuse action with progress. Every unnecessary transaction or portfolio adjustment creates friction, taxes, fees, and emotional strain that erodes returns. Graham's advice: minimize intervention. Let time and compound interest play into the system. Wealth is rarely created through clever maneuvers. It is preserved and multiplied through patience and rational decision-making. Financial independence isn't about ostentatiousness or excitement. It's about having quiet control over one's future. It's the ability of investments to consistently generate returns without panic, distraction, or interference. Investors who embrace this philosophy enjoy both returns and peace of mind. True passive income is the behavioral mastery that comes from owning enduring assets. It's the cumulative reward of rational patience and is available to anyone willing to resist the temptation of constant innovation and instant gratification. Understanding risk is central to Graham's philosophy. Risk isn't short-term fluctuations in stock prices, it's the permanent loss of capital. Investors obsessed with market timing or following trends misunderstand this fundamental principle. Owning high-quality businesses and holding them through market cycles mitigates real risk. Dividends, earnings, and intrinsic value provide a security that speculation can't replicate. The patient investor benefits not from intellect, but from consistency, discipline, and an understanding of the difference between price and value. Graham warned against the seductive illusion of effortless income. Many people believe that wealth can be created with minimal thought, or that complex strategies or algorithms will replace judgment. Passive income isn't magic. It's arithmetic combined with self-control. A well-chosen, consistently profitable company generates cash that can be reinvested to generate more cash. The investor's role is to avoid mindless analysis, avoid unnecessary interventions, and allow time for the results to multiply exponentially. Boredom is the ultimate test. Most people fail not because of a lack of intelligence, but because they can't stand the monotony of disciplined investing. Compound interest requires a long period of apparent inaction. Graham emphasized that doing nothing when it's convenient is an active decision. This is the most difficult form of work, resisting temptations, ignoring the noise, and allowing assets to quietly grow unimpeded. Every sudden transaction or portfolio adjustment disrupts compound interest and reduces long-term returns. The beauty of dividends lies in their reliability and predictability. Graham encouraged investing in companies that consistently generate profits and distribute a portion of those profits to shareholders. Over decades, this creates a self-perpetuating cycle. Reinvested dividends generate more stock, and more stock generates more dividends, and the process accelerates. This compound interest forms the root, the source of passive income, a disciplined, predictable, and sustainable flow of resources. Even extraordinary events like wars, recessions, and market crashes can't derail this strategy when fundamentals are strong. People continue to buy their essentials, pay their bills, and use services that continue through cycles. An investor committed to intrinsic value is largely immune to panic. Short-term price fluctuations are irrelevant. The focus is on the underlying business. This requires courage and patience, sitting quietly while others react emotionally, investing steadily while others speculate, and relying on arithmetic rather than intuition. According to Graham, behavioral mastery is the ultimate determinant of financial success. Intelligence alone doesn't create wealth. Patience, self-discipline, and rational decision-making do. By avoiding impulsive decisions, resisting the temptation of short-term gains, and embracing long-term compound interest, investors transform time into their most powerful ally. Wealth is not achieved through complexity, but through understanding human behavior, acquiring quality assets, and allowing them to thrive. Graham always compared investing to farming. A farmer plants seeds, waters them, and patiently awaits the harvest. The investor buys shares of solid companies, reinvests the dividends, and lets the years work their magic. Short-term fluctuations are irrelevant. The focus remains on the long-term harvest. Trying to accelerate the process, buying frequently, chasing fashion trends, or using leverage, often destroys the crop before it matures. Time is the true multiplier, and limitation is the fertilizer that fuels compound interest. Understanding intrinsic value is fundamental to Graham's philosophy. Every investment should have a margin of safety, a buffer between the price paid and the true value. This margin protects the investor from errors of judgment, economic downturns, and unforeseen events. It allows them to hold on securely during turbulence without panicking. True passive income comes from owning companies whose value exceeds their price, not from chasing hot trends or high returns devoid of substance. Discipline in investing is more valuable than intelligence. Many intelligent people fail because they cannot control their impulses or ignore the noise. Markets are designed to stir emotions. Headlines, analyst opinions, and daily fluctuations encourage investors to act irrationally. Graham taught that the best course of action is often inaction. Waiting while others are panicking, investing calmly while others are speculating, and resisting unnecessary intervention are the unwavering principles of enduring success. Reinvesting earnings multiplies results exponentially. Every dividend, every profit reinvested in quality assets, grows with compound interest over decades. Graham emphasized that the investor's role is to choose wisely and then allow the natural process of compound interest to unfold. This principle forms the basis of his strategy for living sustainably and predictably with passive income. The magic lies not in discovering the next big thing, but in consistently adhering to proven principles. Graham also emphasized the importance of diversification not as a tool for chasing returns, but as a shield against error and uncertainty. Owning a variety of fundamentally sound assets reduces exposure to a single failure. Diversification does not mean overtrading or reacting to short-term market movements. This means allocating risk wisely and then standing firm, allowing the portfolio's total returns to quietly grow over time. A fundamental lesson in Graham's framework is the distinction between speculation and investment. Speculation is short-term, driven by emotions, hype, and market predictions. Investing, on the other hand, is deliberate, based on analysis, and focused on intrinsic value. Passive income comes from investing, not speculation. An investor who understands this will avoid the incessant noise and distractions that lead to the ruin of others. Self-control is the invisible engine of wealth. When an investor avoids selling in panic or succumbing to the temptation to chase a trending investment, they effectively multiply their returns. Graham believed that the average investor could achieve extraordinary results simply by following these timeless rules. Focus on value. Be patient. Reinvest your earnings, and let time enhance your efforts. Emotional stability is central to Graham's approach. Most investors fail not because of a lack of intelligence, but because of a lack of temperament. Fear and greed dominate decisions, leading to impulsive buying at market peaks and panic selling at market troughs. Graham emphasized the importance of viewing the market as a tool, not a master. By remaining calm and patient, the investor ensures the uninterrupted operation of compound interest. Wealth grows silently, almost invisibly, until, decades later, it becomes undeniable. Graham frequently warned against the lure of easy money. Promises of effortless income, high returns, or quick fortunes are often traps. True passive income requires initial effort, careful analysis, selecting undervalued securities, and investing capital. Once these steps are taken, patience is the key. The investor's primary role is to resist temptations, ignore speculation, and navigate market cycles. This is the essence of financial discipline. The margin of safety principle also applies to behavior. Graham believed that protecting capital is more important than chasing returns. Avoiding losses allows compounding to operate effectively. Preserving wealth is as crucial as generating it. Investors should focus on quality assets whose earnings are stable and predictable. Companies with durable competitive advantages, capable management, and consistent cash flow form the backbone of a passive income strategy. They provide reliability in an unpredictable world. Graham often illustrated the power of reinvestment with numbers. A modest initial investment, compounded over decades, grows far beyond intuitive expectation. Small, consistent contributions to a high-quality portfolio magnify over time, producing a stream of income that can eventually surpass active earnings. This is the mathematics of patience. It's not glamorous, but it's unstoppable. Those who adhere to this strategy rarely notice progress in the short term, but over the long term, results are profound. Avoiding unnecessary complexity is another Graham hallmark. He cautioned against exotic instruments, leveraged trades, or speculative vehicles. Simplicity reduces risk and minimizes opportunities for error. Owning ordinary businesses, those producing goods and services people need regardless of market conditions, provides a dependable source of income. It is the ordinary, reliable, and unexciting companies that generate extraordinary wealth over time. Graham also stressed the importance of planning for the long term. Impatience is the enemy of compounding. Investors must accept that wealth accumulation is gradual, not instantaneous. Those who treat investing as a short-term game are almost certain to fail. The investor's advantage comes from the willingness to endure monotony and apparent inactivity. By staying the course, the passive income investor harnesses the cumulative power of earnings over decades. The avoidance of market noise is a critical component of success. Headlines, pundits, and social trends provoke action that often harms wealth. Graham taught that ignoring external distractions allows rational judgment to prevail. The investor should focus on fundamentals, intrinsic value, and long-term prospects, rather than reacting to every piece of news. The less one interferes, the greater the rewards, as compounding works best when uninterrupted. Graham's philosophy turns the concept of work on its head. Active effort does not equal results. In investing, mental labor, analysis, restraint, patience is more valuable than constant action. The investor's challenge is to resist the urge to intervene. Each unnecessary trade, each reaction to short-term volatility erodes potential gains. Compounding demands silence, not noise. The real work is in preparation, not in constant adjustment. Understanding intrinsic value is key. Graham taught that every investment has a calculable worth, distinct from its market price. Buying below intrinsic value offers a built-in buffer, margin of safety, that shields the investor from errors, volatility, and unforeseen events. Over time, the market aligns with intrinsic value, rewarding the patient and disciplined investor. Attempting to outguess the market or chase trends is the path to frustration and loss. Graham's approach relies on rational analysis, not speculation. Reinvestment is the engine of passive income. Every dividend, every interest payment, every profit returned to the portfolio must be redeployed intelligently. This accelerates compounding, converting a small initial stake into a substantial income stream over decades. Graham's examples repeatedly show that even modest, consistent contributions grow into significant wealth when left undisturbed. The discipline to reinvest systematically is as crucial as the original selection of securities. Diversification, according to Graham, is a tool to manage risk, not a source of higher returns. Owning too many assets dilutes attention and reduces the probability of identifying undervalued opportunities. The careful investor chooses fewer, higher quality businesses and holds them through economic cycles. The focus should be on quality over quantity, durability over excitement. Graham called this the principle of defensive investing, protecting the investor's capital while securing consistent income. Psychological endurance is central. The market constantly tests patience with fear, euphoria, and uncertainty. Graham emphasized that true investors must be comfortable standing apart from the crowd, ignoring the frenzy, and sticking to rational principles. Acting differently from the majority, especially during panic or euphoria, is not just recommended, it is essential. Those who can maintain composure accumulate wealth, while the impatient majority often suffers losses. Graham repeatedly warned against the illusion of quick wealth. High-yield schemes, trendy stocks, and speculative bubbles are dangerous distractions. Real passive income is grounded in tangible assets and sustainable earnings. Companies that produce essential goods or services, food, energy, healthcare, consumer staples, provide predictable cash flow. By holding such businesses, investors allow time and reinvestment to generate meaningful income without requiring constant oversight. The lesson of consistency cannot be overstated. Wealth is rarely created in leaps. It is built through a series of rational, repeatable decisions. Graham's method is deliberately unglamorous. Invest prudently, hold firmly, reinvest returns, and avoid emotional reactions. Over years and decades, these seemingly mundane actions accumulate into extraordinary financial security. Success favors those who treat investing as a discipline rather than a game. Graham's approach emphasizes the value of patience as a form of power. Time, compounded with disciplined decisions, amplifies returns far more reliably than market speculation ever could. Investors often misunderstand the nature of activity in investing. Busy trading, chasing trends, or attempting to outsmart the market creates noise, not wealth. The true activity is analytical, researching businesses, assessing balance sheets, understanding industry fundamentals, and then stepping back to let the investment grow. Margin of safety remains the cornerstone. Buying a stock or bond below its intrinsic value creates a cushion against unforeseen market movements. Graham insisted that the investor should prioritize protection over profit. Wealth is preserved not by prediction, but by prudence. The higher the margin of safety, the less psychological stress accompanies the investment. This allows the investor to act rationally, resist panic, and let compounding work over decades. Quick returns are illusions. The steady accumulation of wealth through intelligent, patient investing is the reality. Reinvestment, compounded over time, transforms modest beginnings into substantial outcomes. Graham illustrated that the process works best when investors refrain from touching the capital unnecessarily. Each reinvested dividend, interest payment, or profit is another seed for future growth. The key is consistency, small, regular contributions, compounded over long periods, create exponential results. Graham's philosophy teaches that wealth accumulation is a marathon, not a sprint. Psychology is often the most critical factor in investment success. Human nature drives impatience, fear, and greed, all of which can erode returns. Graham highlighted the need for emotional discipline. The investor must act counter to mass sentiment, buying when others panic and holding when others chase hype. This approach requires confidence in analysis, detachment from daily market noise, and acceptance that true gains are often invisible in the short term. Diversification is important, but must be balanced with focus. Owning too many assets spreads attention too thinly, reducing the capacity to evaluate each business carefully. Graham recommended concentrated investments in high-quality companies that are undervalued. Fewer, well-chosen holdings allow the investor to monitor intrinsic value, manage risk, and maximize the benefits of compounding. Quality and stability outweigh excitement and novelty in this framework. The illusion of effortless income is a persistent trap. Many pursue passive income as if it were an immediate reward, seeking shortcuts or magic formulas. Graham's teachings counter this by emphasizing that sustainable passive income emerges only through ownership of productive assets and disciplined reinvestment over time. True passive income requires foresight, temperance, and patience. It grows quietly, often unnoticed, until it reaches a stage where it surpasses active labor in significance. Finally, Graham reinforces the idea that wealth is behavioral first and knowledge second. A brilliant analysis is worthless if the investor lacks patience or succumbs to emotion. The disciplined investor, who avoids impulsive decisions and remains loyal to carefully selected investments, accumulates enduring wealth. Time compounds rational choices into financial independence. Those who chase novelty, speculation, or short-term gains often forfeit this advantage. Graham also emphasized the separation between investing and speculation. Speculation involves predicting short-term market movements, attempting to time highs and lows, or chasing hot trends. Investing, in contrast, focuses on the underlying value of assets, their earnings power, and their capacity to generate real, sustainable returns. The speculative mind is restless, seeking constant action. The investor's mind is steady, guided by rational analysis and reinforced by historical principles. True passive income is built by investing, not by speculating. The principle of do nothing when doing nothing is correct is central to Graham's philosophy. He taught that inaction, guided by careful selection and rational judgment, often yields the greatest results. This contradicts the modern obsession with constant trading or micromanaging portfolios. Compounding cannot accelerate through noise. In fact, every unnecessary action often reduces returns. The patient investor waits while the market's short-term volatility unfolds, secure in the knowledge that value will reveal itself over time. Income generation through dividends and interest exemplifies this philosophy. A well-chosen investment continues to produce cash flows even while the investor sleeps. Graham likened this to owning productive machinery. Once acquired, it works independently, delivering results without daily intervention. However, The key is not only the acquisition, but the decision to reinvest those earnings wisely. Each dividend reinvested compounds wealth silently, quietly creating a financial ecosystem that grows exponentially with minimal effort. Patience, Graham argued, is a form of discipline that directly translates into financial returns. Investors are often tempted by excitement, new sectors, emerging technologies, flashy financial products. But these frequently carry hidden risk or inflated valuations. Enduring companies, selling everyday products, providing essential services, or maintaining strong balance sheets, offer stability and reliable returns. By selecting these assets, holding them over decades, and ignoring short-term market noise, the investor allows compounding to amplify initial decisions into substantial wealth. Behavioral consistency is as important as analytical skill. Graham insisted that the greatest danger in investing is emotional interference. Anxiety, fear, greed, or envy leads to impulsive trading, reducing long-term returns. He emphasized that an investor's greatest advantage is the ability to sit still, resist panic, and let time magnify the results of rational choices. In essence, the market punishes impatience and rewards steadfast discipline. Another key principle is buying assets below intrinsic value, the margin of safety. This ensures that even if market conditions deteriorate or errors are made in analysis, the investment retains sufficient protection. This cushion reduces risk, allowing the investor to remain calm and objective. Graham showed that preserving capital is often more important than chasing immediate profit. By respecting the principle of margin of safety, the investor builds a foundation on which compounding can operate efficiently. Finally, Graham's philosophy frames passive income not as instantaneous wealth, but as delayed gratification. It requires consistency, rational judgment, and avoidance of impulsive behavior. The investor must align with the natural rhythm of the market, respecting its fluctuations while relying on fundamentals. True passive income grows over years, emerging as a reliable and resilient source of financial freedom. Graham often reminded investors that emotional stability is the cornerstone of successful investing. Many fail not because they lack intelligence or access to information, but because they cannot manage their reactions to short-term market movements. When prices fall, panic drives them to sell. When prices rise, euphoria tempts them to overpay. The disciplined investor, in contrast, remains detached, using these fluctuations as opportunities rather than threats. This detachment transforms ordinary investments into sources of long-term income. True passive income, in Graham's framework, comes from assets that endure economic cycles. Stocks in companies with predictable earnings, strong financial health, and reliable product demand continue to produce returns regardless of temporary turmoil. Unlike speculative ventures, these investments are not dependent on fleeting trends, hype, or market sentiment. By holding such assets, reinvesting earnings, and avoiding interference, the investor creates a system that functions independently, generating wealth silently and consistently. Graham emphasized diversification, not to chase higher returns, but to protect the portfolio against unforeseen events. A diversified portfolio of quality businesses reduces risk while maintaining steady income streams. However, diversification should not become overcomplication. The goal is to own enough assets to spread risk, but not so many that oversight becomes impossible or the portfolio loses focus. Fewer, well-chosen investments held over the long term often outperform a heavily traded, unfocused collection of speculative bets. Another principle Graham stressed is the importance of simplicity. Financial complexity, he argued, often masks risk rather than mitigating it. Sophisticated derivatives, exotic investment schemes, or trendy financial instruments promise high returns, but frequently carry hidden dangers. In contrast, straightforward investments in productive businesses provide clarity and predictability. Graham taught that simplicity paired with discipline is more powerful than intelligence paired with impulsivity. The quiet, methodical approach consistently compounds wealth over decades. The reinvestment of income, particularly dividends, is central to Graham's philosophy. He demonstrated that income left to compound within the system exponentially increases overall returns. Each dividend, when reinvested into solid assets, generates further dividends, creating a snowball effect. Over time, this leads to a substantial accumulation of wealth that is largely independent of market timing or short-term trading decisions. Patience and consistency amplify this effect, illustrating the power of disciplined, passive investing. Graham also highlighted the importance of valuation in generating passive income. Buying assets below their intrinsic value provides a margin of safety, reducing the risk of permanent loss and increasing the likelihood of steady returns. This practice encourages rational behavior over impulsive speculation, ensuring that investments continue to produce reliable income even during periods of market turbulence. By prioritizing value over hype, the investor aligns with long-term wealth creation. Finally, Graham framed passive income as a byproduct of sound judgment and ethical behavior. Investments should be selected not only for profitability, but also for sustainability and integrity. Companies that consistently serve customers well, maintain ethical practices, and operate efficiently provide reliable, long-term returns. In this context, passive income is less about mechanical formulas or financial engineering and more about human decision-making guided by prudence, patience, and discipline. Graham also insisted that the key to enduring wealth lies in resisting the temptation to react to every market fluctuation. Investors are often their own worst enemies, driven by fear and greed rather than rational analysis. Graham's approach counseled patience, waiting for opportunities and letting the market work in your favor rather than trying to chase short-term gains. This patience transforms ordinary investing into a form of disciplined compounding, where time is the greatest ally. The power of consistency cannot be overstated. Graham advocated for a regular investment routine, allocating funds to high-quality assets, reinvesting dividends, and steadily increasing contributions as income grows. Small, consistent actions over decades generate outcomes that often surprise those who expect immediate results. In this sense, passive income is not about inactivity. It is about deliberate, disciplined consistency. Each reinvested dividend, each patient year, magnifies the effects of compound interest, creating a self-sustaining growth engine that eventually exceeds the results of more aggressive, riskier strategies. A fundamental Graham principle is the concept of intrinsic value. Understanding what a business is truly worth provides clarity and confidence. By purchasing assets at prices below intrinsic value, an investor gains a margin of safety that protects against market volatility. This margin not only reduces downside risk, but also allows the investor to maintain composure during economic downturns, knowing that the underlying asset remains sound. Over time, these undervalued investments grow in value, generating steady income without the need for constant attention or speculation. Graham also warned against the illusion of hot tips or market trends. Financial media and popular culture often promote excitement over prudence, convincing investors that wealth comes from activity rather than judgment. The disciplined investor, however, ignores noise and focuses on fundamentals. This ability to resist distraction is itself a form of wealth creation. By avoiding impulsive trades, unnecessary portfolio adjustments, and speculative ventures, the investor ensures that compounding works uninterrupted. The psychology of investing is central to Graham's philosophy. Emotional restraint and rational behavior outweigh technical expertise. He frequently noted that investors with average intelligence but superior temperament often outperform more knowledgeable but emotionally reactive peers. Mastering one's impulses, resisting fear during declines, avoiding greed during rallies, is the ultimate tool for generating passive income. True wealth accumulates quietly, often unnoticed by those who seek drama and excitement in their financial lives. Another cornerstone of Graham's approach is the understanding of long-term trends. Economic cycles, inflation, recessions, and booms are constants, but consumer behavior and essential industries endure. Companies producing staple goods, food, household items, healthcare products, remain resilient through turmoil. By focusing on businesses that provide indispensable products and services, investors secure steady returns that are less sensitive to macroeconomic volatility. This focus on permanence and reliability is the essence of sustainable passive income. Finally, Graham emphasized prudence over speed. Wealth built quickly is often fleeting, while wealth accumulated steadily and thoughtfully tends to endure. The discipline to act slowly, to evaluate carefully, and to resist the urge to chase every opportunity separates successful investors from the majority. Passive income, under Graham's principles, is a reward for patience, rational judgment, and disciplined restraint. It is the natural outcome of behavior aligned with the timeless rules of value investing, a quiet yet unstoppable force in wealth creation. Graham also stressed that diversification is not merely a buzzword but a critical safeguard. By holding a portfolio of carefully selected, high-quality assets, an investor reduces the impact of any single failure. Yet diversification should not become a trap for mediocrity. Owning dozens of mediocre companies dilutes returns. The goal is to combine a few well-understood businesses with enduring value, ensuring both security and meaningful growth. Graham called this intelligent diversification. Enough variety to protect, but not so much that it undermines performance. He repeatedly warned against the siren call of speculation. Many investors mistake activity for intelligence, believing that frequent trades or complex financial instruments will accelerate wealth. In reality, such behavior increases costs, taxes, and exposure to market whims, often eroding capital. Graham's approach was the opposite: slow, thoughtful accumulation of undervalued assets, followed by patient holding. The compounding effect of dividends and capital growth, left uninterrupted, outweighs the fleeting excitement of rapid trading. Another principle Graham emphasized is understanding the difference between price and value. The market's daily fluctuations often obscure the true worth of a company. A stock price drop may provoke panic in the impulsive investor, but for the disciplined one, it represents opportunity. By buying when prices fall below intrinsic value, the investor not only gains potential profit, but also strengthens the margin of safety. Over decades, this principle of value purchase ensures that the portfolio grows steadily, with minimal risk of permanent loss. Graham also considered reinvestment a cornerstone of passive income. Rather than extracting earnings, reinvesting dividends and profits allows the portfolio to snowball over time. Each reinvested dollar becomes a miniature worker, generating more earnings that feed into the next cycle. Patience amplifies this effect. A decade of compounding transforms modest contributions into substantial wealth. Importantly, This method does not rely on predictions or timing the market. It relies on arithmetic, discipline, and the enduring power of good businesses. Equally critical is the avoidance of emotional interference. Graham noted that investors frequently sabotage their returns through fear or greed. Panic during market declines leads to premature sales, while exuberance during rallies tempts overpayment for assets. By cultivating a temperament of rational detachment, an investor can maintain consistent growth and secure passive income. Graham's famous observation that the market is a voting machine in the short term and a weighing machine in the long term underscores the importance of focusing on fundamental value rather than fleeting sentiment. Finally, Graham urged investors to embrace simplicity. Wealth does not require complicated algorithms, exotic instruments, or daily monitoring. It requires the repeated application of a few sound principles. Spend less than you earn, buy undervalued assets, reinvest earnings, and hold with patience. By resisting distraction and trusting in the arithmetic of compounding, even the average investor can achieve financial independence. In Graham's philosophy, true passive income is less about inaction and more about disciplined, deliberate restraint, a consistent rhythm of intelligent decisions, amplified by time. Graham often illustrated his philosophy with a simple analogy: the investor as a business owner. When you purchase shares in a company, you are not merely buying a ticker symbol. You are acquiring a portion of a real business. This perspective transforms how you view risk, reward, and patience. Dividends become the salary of ownership, profits reflect the company's success, and market fluctuations are minor distractions. By thinking like an owner rather than a speculator, the investor gains a sense of control and reduces emotional volatility. He also emphasized the value of predictability. While excitement and innovation may dominate headlines, sustainable wealth is built on businesses that satisfy fundamental human needs. Food, utilities, consumer goods, and essential services continue to perform regardless of economic cycles or political shifts. Investing in these enduring businesses ensures that cash flows remain reliable, forming the backbone of long-term passive income. Graham referred to this as the margin of safety, the buffer provided by dependable earnings against inevitable market turbulence. A key element of Graham's guidance is avoiding the trap of overconfidence. Investors often believe that knowledge of the latest trend or technology gives them an edge. Graham reminded them that market behavior is unpredictable, and luck plays a more significant role than most admit. By focusing on what is knowable, financial statements, historical performance, and intrinsic value, an investor gains a measurable advantage. The rest is speculation, and speculation is not investing. Passive income, in Graham's view, is the reward for ignoring noise and letting real economic value do the work. Reinvestment strategies were central to Graham's formula. Each dividend, each profit distribution, should be redeployed into similarly sound assets. Over decades, this cycle of reinvestment creates a self-sustaining income engine. Importantly, the investor's task is not to constantly search for the next high-yield opportunity, but to nurture the assets already in hand, allowing them to compound naturally. In essence, Graham's approach transforms time from an adversary into an ally, leveraging patience as the primary source of returns. Equally vital is the discipline to say no. Graham taught that the hardest part of investing is restraint, declining bad opportunities, resisting speculative fads, and avoiding impulsive decisions. Each avoided mistake protects capital and preserves the snowballing effect of compounding. In his writings, he often contrasted the patient investor with the impulsive speculator. One accumulates wealth steadily over decades, while the other chases excitement, and loses money in the process. The difference is not intelligence but temperament. Graham also warned about the dangers of imitation. Many investors pursue strategies seen in magazines or endorsed by celebrities, believing they will replicate someone else's success. However, copying without understanding the underlying logic is a recipe for failure. Graham emphasized independent thinking. Analyze the numbers, understand the business, and make deliberate, informed choices. Passive income grows from this foundation of informed patience, not from trendy speculation or surface-level imitation. Finally, Graham framed the psychological benefits of passive income. Financial independence is not just wealth. It is freedom, the ability to make choices without compulsion, to act based on preference rather than necessity. By adhering to sound principles, reinvesting earnings, and exercising patience, investors cultivate both financial security and personal autonomy. The rewards of Graham's approach extend beyond numbers. They provide a framework for calm, deliberate living, insulated from the chaos of markets and human impulse. Graham often returned to the theme of intrinsic value. Unlike fleeting trends or hype-driven opportunities, intrinsic value reflects the true worth of a business based on its earnings, assets, and long-term prospects. Investors who focus on this fundamental measure gain clarity and confidence, avoiding the anxiety caused by daily market swings. When you understand what a company is truly worth, temporary price drops are not threats, they are opportunities. This mindset transforms the stress of investing into a calculated patience game, where decisions are informed by reason, not emotion. Another cornerstone of Graham's philosophy is diversification, but not over-diversification. He warned against owning hundreds of securities, which can dilute returns and create unnecessary complexity. Instead, he advocated for concentrated ownership in carefully selected businesses that meet strict criteria for stability, profitability, and ethical management. By holding a manageable number of high-quality assets, the investor maintains focus, understands risks intimately, and allows compounding to work unhindered. Each additional stock must pass rigorous scrutiny. Otherwise, it is an unnecessary distraction. The discipline of Graham-style investing also requires emotional detachment. Market excitement encourages investors to buy and sell quickly, chase momentum, or succumb to fear. Graham advocated a calm, almost clinical approach. Reacting to headlines, rumors, or temporary economic panic only erodes returns. Instead, a disciplined investor waits for rational opportunities, assesses them clearly, and then returns to observation and assessment. Time, patience, and rational decision-making become the true engines of wealth. He also emphasized the importance of a margin of safety. This principle protects against errors in judgment or unforeseen downturns. By purchasing assets below their true value, the investor ensures that temporary setbacks don't destroy wealth. A margin of safety isn't a guarantee of profit. It's a buffer that ensures compound interest continues uninterrupted. Graham strongly advocated that this is the ultimate guarantee for passive income because it maximizes potential while minimizing risk over the long term. Graham's approach also extends to personal behavior. Spending less than you earn, saving diligently, and avoiding debt are essential components of sound investing. Passive income is born not from exceptional intelligence, but from consistent, rational habits repeated over decades. Frugality, discipline, and long-term thinking amplify the effects of compound interest, transforming modest gains into lasting financial security. At its core, an investor's character becomes the greatest determinant of success. He warned against chasing high-yield temptations, whether speculative stocks, leveraged plans, or media-promoted fads. Graham recognized human nature's desire for instant gratification and excitement, but emphasized that these impulses destroy wealth. True passive income requires delaying gratification, accepting monotony, and resisting the urge to act on emotion. For centuries, these patient practices have yielded far greater rewards than any short-term thrill could ever provide. Graham also believed in simplicity. Investors don't need complex formulas, sophisticated software, or insider knowledge. A handful of well-chosen holdings, consistently held and prudently reinvested, deliver predictable and reliable returns. Complexity often masks risk and encourages action. Simplicity, combined with discipline, allows compound interest to do the heavy lifting. The most effective strategy is often the least glamorous. Buy value, hold it, reinvest it, and repeat for hundreds of years. Benjamin Graham often reminded me that the most overlooked principle of wealth is not flashiness, speed, or cleverness, but consistency. You don't get rich because you're the smartest person in the room. You get rich because you refuse to be the most emotional. Every market panic, every bubble, every flashy trend tests one thing. Can you control your nerves? If you can, you automatically win. This is the essence of passive income. It's not about being constantly in motion. It's about consistently doing nothing wrong. Investors fall into the trap of action addiction. They believe that action equals mastery. They obsessively follow charts, switch funds every quarter, or chase the next big thing because inaction feels like failure. Graham would laugh at this. True wealth is built by realizing that inaction, guided by rational analysis, is the most productive activity. The market rewards judgment, not action. If you're patient, disciplined, and willing to hold quality assets for decades, your money will do all the heavy lifting. Owning a great business isn't a thrilling journey. It's a commitment. A company producing basic necessities, run by competent managers, provides the rarest kind of security, predictability. Graham often emphasized that the smart investor buys for the long term, not for headlines or hashtags. Reinvest dividends. Ignore the noise. This isn't glamorous advice and rarely creates exciting stories. But as long as you stick with it, it works flawlessly. Benjamin Graham always emphasized that investing isn't about chasing fame. It's about rational patience and a quiet determination to let good decisions accumulate and gain value. While everyone else is immersed in headlines, stock tips, and market noise, the intelligent investor focuses on what truly matters, the intrinsic value of their assets. There's no rush, no drama, no pressure to outperform the market every day. The goal is steady, predictable growth fueled by time and discipline. Owning productive assets is like planting a grove of trees. You water them, maintain them occasionally, and let nature take over. The temptation to uproot them early, to seek excitement, to optimize them daily is the greatest threat to wealth. Compound interest isn't glamorous. It's quiet, relentless, and neutral. It doesn't care about the latest trend, the smartest analyst, or the flashiest innovation. It rewards resilience, common sense, and composure. Graham can remind you, the market is a mechanism that tests your temperament more than your intelligence. Those who persevere are the winners. Graham's wisdom comes not from always chasing gains, but from avoiding losses. True passive income comes from careful choices, conservative thinking, and resisting impulses. When you pursue returns without understanding, you invite risk disguised as opportunity. Investors who stick to solid, straightforward practices, reinvest dividends, and avoid the temptation of speculation will steadily accumulate wealth. Mistakes accumulate and grow faster than good decisions. Ignoring them is as important as making the right choices. True passive income is a marathon, not a sprint. Start early, invest consistently, reinvest your earnings, and resist the temptation to intervene. Every hasty step, every impulsive trade, wears down the compound interest engine you've built. Graham understood that security and freedom come from predictable, long-term results. It's not about the thrill of trading or the allure of instant gains. The goal is to build a portfolio that can withstand centuries of human folly and still deliver consistent returns. Time is your greatest ally. Your best tool is rational patience. Your greatest enemy is impatience and noise. If you embrace Graham's philosophy, the task is simple. Spend less than you earn, invest in solid businesses, reinvest all your earnings, and ignore distractions. The wealth you build will be quiet, reliable, and ultimately liberating. Financial independence isn't about showing off. It's about letting your life be controlled by reason, not by circumstances, fear, or exaggeration. Ultimately, the true secret to wealth isn't flashy moves or clever timing. Graham's philosophy reminds us that owning quality businesses, reinvesting dividends, and letting time do its work is the surest path to financial freedom. There's no need for rushing, shortcuts, or a secret formula. There are only sound decisions that have been repeated for centuries. Your portfolio doesn't need constant attention. It needs patience, discipline, and a mind that can resist panic. The returns from this approach may seem invisible at first. Nothing dramatic happens over the years. But over time, the compound interest effect grows silently, invisibly, and inexorably. The average investor, drawn to trends and excitement, often overlooks this fact. However, those who understand Graham's timeless lessons, those who embrace the tedious and disciplined path, find themselves financially independent, free from the vagaries of the market, and confident that their wealth will grow as they live their lives. If you enjoyed this article exploring Benjamin Graham's passive income approach, don't forget to subscribe to the channel and leave your thoughts in the comments. Your participation helps keep this journey going and ensures you don't miss future stories. Speaking of future stories, imagine the lesson of an investor who turns crises into fortunes, who sees opportunity where everyone else sees chaos. In our next article, we'll reveal the mindset that enabled one man to succeed when the world was in panic, and this mindset could change your perspective on money forever. Stay tuned.